What happens to the real estate market when all the boomers are gone? That question sounds harsh, but the real issue is not death. It is transfer. It is ownership. It is what happens when one generation that bought homes before prices detached from wages slowly leaves behind houses, equity, debt, taxes, memories, and a market that younger buyers already feel locked out of. This is not a prediction of one giant housing crash. Markets rarely move like a light switch. The more realistic story is slower, stranger, and more uneven. Some homes will finally come up for sale. Some will be inherited. Some will be rented out. Some will sit empty. And some will be fought over. The uncomfortable truth is that America has built a housing market where age matters almost as much as income. Older owners often have equity. Younger buyers often have rent receipts, student loans, childcare bills, and mortgage quotes that feel almost insulting. So when people ask what happens after the boomers are gone, they are really asking a bigger question. Will their houses open the door for the next generation, or will those houses simply become another asset class for people who already have money? The answer begins with a fact many people feel but do not always name. The housing market is not just about homes. It is about who owns the homes, who can borrow against them, who can wait, and who is forced to move at the worst possible time. Baby boomers were born into a very different housing ladder. Not an easy life, not a perfect life, and not the same life for everyone. But many entered adulthood when homes were more closely tied to local wages, land was cheaper, and mortgage math did not look as cruel. That early entry mattered. A home bought decades ago did more than provide shelter. It became forced savings, inflation protection, neighborhood stability, collateral, and sometimes the only major asset a family ever owned. Now that same home can look absurd to younger buyers. A simple ranch house, a split level, a house with old cabinets and a tired roof. But the asking price can still carry decades of scarcity, low supply, zoning limits, and the silent power of accumulated equity. This is why the boomer question creates so much emotion. Younger people are not just waiting for houses, they are waiting for a system to loosen its grip. Older people are not just sitting on inventory. Many are trying to age with dignity in the only place that still feels safe. Both things can be true. The young can be squeezed, and the old can be vulnerable. The market can be unfair without every homeowner being a villain. That is what makes this story more complicated than a social media argument. Recent national housing surveys show baby boomers still represent a massive share of buyers and an even larger share of sellers. They are not just fading from the market. They are still shaping the market with cash, equity, timing, and the ability to choose. One major survey found boomers were the largest generational group of recent home buyers, while first-time buyers fell to a record low share. That tells you almost everything about the current market. Ownership is not simply moving down the age ladder. Boomers are also a dominant group of sellers. But selling does not always mean freeing inventory for young families. Sometimes it means selling one home and buying another. Sometimes it means downsizing into the same smaller homes younger buyers want. That is one of the biggest misunderstandings in the whole debate. People imagine older owners leaving large houses and younger families rushing in. But many older owners also want smaller, safer, lower-maintenance homes near doctors, family, stores, and friends. That puts them in direct competition with first-time buyers. The retired couple with cash from a paid-off house can be bidding against the young couple with an inspection clause, a loan approval, and a monthly payment already stretched to the edge. So when the boomers are gone, the market may not simply become cheaper. It may become more liquid. More homes may move, more estates may sell, more neighborhoods may turn over. But price relief depends on whether supply finally exceeds demand where people actually want to live. That last phrase matters. Where people actually want to live. Housing is local. A national headline can say, inventory is rising, while one city still has bidding wars and another town has houses sitting for months. A boomer-owned home in a strong coastal suburb is not the same asset as a rural house 2 hours from the nearest major job center. One may sell in days. The other may need a price cut, a repair budget, and a buyer willing to compromise. The coming transfer will not hit every zip code the same way. Retiree-heavy counties, aging suburbs, older vacation towns, and cold weather areas with weaker job growth may feel it sooner. High-income metros with limited building may absorb listings quickly. This is why the phrase silver tsunami can mislead people. It makes the future sound like one giant wave crashing at once. Real life is more like a tide. It comes in slowly, unevenly, and with a lot of friction under the surface. People live longer now. Many older homeowners do not want to sell. Many cannot afford to sell. Some would lose a low property tax basis. Some would trade a tiny old mortgage for a brutal new payment. Some simply have nowhere better to go. Aging in place is not just a preference. It is often the cheapest housing plan available. Selling sounds easy until the replacement home costs too much, the apartment rent is high, and assisted living feels financially impossible. That is why a paid-off home can become a kind of private safety net. It may be old, it may need repairs, but it keeps the monthly housing bill lower than almost every alternative. And because many older people are living on fixed or limited incomes, the house can be both wealth and trap. It can hold hundreds of thousands in paper equity while the owner struggles with taxes, insurance, utilities, roof repairs, and medical bills. On paper, that owner may look rich. In real life, the monthly cash flow can still feel tight. This creates a strange market freeze. Younger buyers need listings. Older owners own listings. But older owners also need stability, and selling may expose them to the same affordability crisis everyone else is complaining about. So the first big answer is this. The housing market will not suddenly flood with boomer homes. It will slowly receive them through downsizing, illness, relocation, inheritance, estate sales, and family decisions that are often emotional and messy. When a home passes through an estate, it rarely enters the market cleanly. There may be siblings with different plans. One wants to sell, one wants to keep it, one needs cash, one lives across the country. One thinks the house is worth more than buyers will pay. Then come repairs. Old homes often carry old problems. Roofs, wiring, plumbing, foundations, moisture, heating systems, windows, and outdated layouts. A house can be inherited free and clear and still require a frightening amount of money before it is livable. That is where the next market divide appears. A young buyer may want the home, but not have the cash to fix it. An investor may have the cash, the contractor relationships, and the patience to turn a neglected house into a rental or flip. This is one reason the boomer exit may not automatically create affordability. A home can come up for sale, but if it needs major work, the buyer with cash has an advantage over the buyer who needs financing. Traditional mortgages are not always friendly to houses with serious repair issues. Lenders care about condition, appraisers care about comparable sales. Insurance companies care about roofs and risk. A cheap house can become hard to buy with ordinary financing. So the question is not only how many homes come to market. It is what condition they are in, where they are located, what kind of financing they qualify for, and whether ordinary households can compete before professional buyers arrive. Some heirs will sell quickly because they need to settle the estate. Some will hold because they expect prices to rise. Some will turn the house into a rental because the mortgage is gone and the monthly cash flow looks tempting. That one decision can change a neighborhood. A house that might have gone to a first-time buyer becomes a rental. Not always a bad rental, not always a corporate rental, but still one less entry-level ownership opportunity. Multiply that by thousands of families, and you get a quieter version of the housing crisis. Not a dramatic villain story, just a chain of rational decisions that slowly keeps ownership out of reach. The future also depends on the heirs. Many Gen X and millennial heirs will not be carefree winners. Some will inherit wealth. Some will inherit conflict. Some will inherit deferred maintenance. Some will inherit a house with a mortgage, taxes, liens, or a reverse mortgage balance. That is why the word inheritance can sound cleaner than the process actually is. This matters because inheritance is uneven. The families that already own homes are more likely to pass down assets. The families shut out of ownership are less likely to receive a property windfall. That means the boomer transition can widen inequality even while increasing supply. A house can become a gift, a burden, a bargaining chip, and a family stress test at the same time. Imagine two buyers in the same city. One receives help from a parent selling a long-owned home. The other receives nothing but a rent increase. Both work hard. Both want stability. But the market does not reward effort equally. It rewards assets. That is the housing story nobody wants to say too plainly. The next market may not be young versus old. It may be asset-backed young versus rent-trapped young. Some younger households will inherit houses or down payment money and move faster. Others will watch listings appear and still be priced out because inherited equity will become the new advantage at the negotiating table. The boomer exit may therefore create more transactions without creating fairness. A more active market can still be unaffordable if the buyers with inherited wealth, cash, or high incomes win the best homes first. Now let us talk about the houses themselves. Boomers do not all own the same kind of property. Some own suburban family homes, some own condos, some own vacation homes, some own rural houses, some own nothing at all. The popular image is the big suburban house with unused bedrooms. Those homes will matter. But not every young buyer wants them, and not every young buyer can afford their carrying costs. A large house can come with a large tax bill, high insurance, expensive utilities, landscaping, maintenance, and renovation needs. The purchase price is only the beginning. The monthly reality can scare off buyers who already stretch just to qualify. This is where the market may split. Smaller homes near jobs may stay expensive because everyone wants them. Larger, older homes farther out may soften if families cannot afford the payment, commute, repairs, and energy bills. That does not mean big houses collapse in value everywhere. In strong school districts, wealthy suburbs, and job-rich regions, they may remain desirable. But in slower growth areas, the buyer pool can thin. When the buyer pool thins, sellers learn what real demand looks like. A home is not worth what a family remembers. It is worth what qualified buyers can pay after mortgage rates, insurance, taxes, and repairs are all counted. This is where official economic language can feel cold. Analysts say affordability is constrained. Buyers say the math is insane. Sellers say they just want what the neighbor got. Everyone is describing the same pressure from a different seat. And the math has changed. A home price is not just a price, it becomes a monthly payment. When mortgage rates rise, the same house can feel hundreds of dollars more expensive every month, even if the sticker price barely changes. That is why a boomer-owned home entering the market does not guarantee a young buyer can afford it. The listing may exist, the dream may exist, but the payment may still be too high. Supply matters, but financing decides who can act. If rates remain high, extra listings may cool prices but not restore affordability. If rates fall, demand can surge again and absorb new inventory before prices drop much. This is the frustrating part. Many buyers are waiting for prices to fall, but lower rates can bring more competition. Higher rates can reduce competition, but they also reduce purchasing power. There is no easy door. Boomer inventory will interact with that mortgage math. If many homes come up during high-rate periods, prices may soften more. If they come up during low-rate periods, younger buyers may face another rush of demand. Now add the national shortage. Researchers have estimated that the country remains short millions of homes relative to long-run demand. That shortage is not evenly spread, but it explains why one generation leaving does not instantly fix everything. Even a few million missing homes can keep pressure on prices when the missing homes are the exact homes working families need. We underbuilt for years in many places. We limited density. We fought apartments. We made permitting slow. We treated starter homes as less profitable. Then, we acted surprised when starter homes became rare. Aging homeowners did not create all of that. Builders, local rules, interest rates, land costs, investors, migration, and politics all played a role. But older owners sitting in place became one visible symbol of a deeper supply problem. When the boomers are gone, the inventory picture improves only if homes are actually sold, actually livable, and actually in places where households need them. A vacant house in the wrong place does not solve a shortage in the right place. That is why some markets may feel relief and others may barely notice. A small Midwest city with many aging owners may see more negotiable prices. A supply-restricted coastal metro may simply digest every listing and keep moving. Retirement destinations are another piece. Some warm-weather markets grew because older households brought money, pensions, and home equity. When those households pass on or move into care, the local economy can shift. Places built heavily around retirees may see more homes for sale, more pressure on condos, and more demand for medical services, assisted living, estate services, and property management. Housing turnover can reshape the whole local business mix. But climate risk complicates that story. Insurance costs, heat, storms, water concerns, and repair bills can change what buyers are willing to pay. A retirement dream can become a carrying cost nightmare if insurance jumps faster than income. The older the property and the riskier the location, the more the monthly carrying cost starts to act like a second asking price. This means some inherited homes in high-risk areas may not receive the prices heirs expect. Buyers increasingly look at more than the mortgage. They ask what insurance will cost, whether coverage is available, and what repairs storms may bring. In older northern markets, a different problem appears. Some houses are structurally solid but outdated, energy-hungry, and far from the jobs younger workers chase. Low price alone may not create demand if opportunity is somewhere else. So the boomer transition will not be one story. It will be Florida condos, New England colonials, California bungalows, rural farmhouses, Sunbelt subdivisions, aging townhomes, and suburban houses with floor plans built for a different family life. Each property will face a simple question. Does the next generation want this exact home, in this exact location, at this exact total monthly cost? That total monthly cost is where many people get tricked. Buyers focus on the listing price because it is the number in the headline. But the real cost includes interest, insurance, taxes, repairs, utilities, commuting, fees, and the price of time. This is similar to what happens in everyday shopping. People notice the sticker price, but they miss the system around it. Smaller packages, loyalty prices, coupons, delivery fees, convenience markups, premium versions, and store layouts all shape what people pay. That is why people can feel broke even when the official inflation number says conditions are improving. Grocery stores are a good example because the pain is immediate. A shopper thinks they are making small choices, but the aisle is designed to guide those choices. The bigger cart, the end cap, the sale tag, the private label, the app coupon, the delivery fee. Housing works the same way, just slower and with bigger numbers. The list price gets attention, but the real machinery is financing, taxes, insurance, zoning, closing costs, appraisal rules, repair credits, and who has cash when the deal gets tense. Ordinary shoppers miss grocery pricing patterns because they are busy, tired, and trying to get through the week. Ordinary home buyers miss housing cost patterns because they are emotionally attached, under pressure, and scared someone else will win. The market benefits from that pressure. Not because every agent or seller is bad, but because urgency makes people tolerate costs they would question in a calmer moment. Loyalty cards in grocery stores trade discounts for data. In housing, the equivalent is financial visibility. Your credit, income, debt, down payment, and pre-approval tell the market how far you can stretch. The system learns your ceiling. Private labels in grocery stores promise value by cutting out the famous label. In housing, the value version is the fixer-upper, the farther commute, the smaller lot, the older condo, the place that is technically affordable but loaded with compromise. Coupons make shoppers feel like they are winning, even when the basket still costs more. Seller credits can feel the same way. A credit toward closing costs helps, but it does not always fix an overpriced house, a high rate, or a weak inspection. Delivery apps turn convenience into a stack of fees. Housing has its own convenience fees: moving costs, storage, temporary rent, rate locks, repairs you outsource because you have no time, and services that multiply when life is already stressful. This is why the boomer housing shift will be felt at the kitchen table, not just in charts. Families will ask whether the inherited home should be sold. Buyers will ask whether the payment is survivable. Renters will ask why relief still has not arrived. This is where the story becomes personal, because nobody inherits an abstract market. They inherit a real address with bills attached. Now consider the seller psychology. Many older owners anchor to the highest price they heard during the hottest market. They remember the neighbor who sold fast. They may not fully adjust to higher rates or changing buyer tastes. Heirs can be even more anchored. A childhood home is emotional. People remember holidays, birthdays, sacrifice, and family history. Then a buyer sees old carpet, low ceilings, knob issues, a dated kitchen, and a roof near the end of its life. That emotional gap can delay sales. The house sits. The price drops. The family argues. Meanwhile, buyers wonder why an outdated home is priced like a magazine renovation. Eventually, the market forces clarity. Sentiment does not pay the mortgage. Memories do not pass inspection. Buyers may love charm, but they still calculate repair costs. This could create opportunities for patient buyers. Not every estate seller will demand top dollar forever. Some will value certainty, clean terms, and a buyer who can close without drama. But again, cash buyers benefit. They can accept as-is condition. They can waive repairs. They can move quickly. They can buy what a careful first-time buyer is warned away from. If policymakers want the boomer transition to help younger buyers, they cannot just wait for listings. They need financing tools for repair-heavy homes, more supply, fair appraisal practices, and pathways that let ordinary buyers compete for older housing stock. The homes most likely to help first-time buyers are often the same homes most likely to need repair financing. Accessory dwelling units could matter too. If a large older home can legally include a small rental unit, a younger buyer may afford it more easily. If an older owner can add a unit, they may age in place while creating new housing. But local politics often slows that down. People say they support affordability until the new unit is on their block, the duplex is near their yard, or the parking situation feels personal. That is another reason the market may not self-correct. Demographics can create openings, but rules decide what those openings become. A house can be turned into flexible housing, or it can be locked into one old pattern. Zoning is not exciting, but it is powerful. It decides whether one lot can hold one family, two households, an in-law suite, a small apartment, or nothing new at all. That decision shapes prices for decades. When the rules make modest building illegal or painfully slow, scarcity becomes a local policy choice dressed up as neighborhood character. Builders also respond to incentives. If land is expensive and rules are strict, they often build higher-priced homes because that is where the margin is. The missing starter home is not an accident. It is the result of math. So when boomer homes enter the market, some builders and investors may see land value more than house value. The old house may be torn down. The replacement may be larger, more expensive, and aimed at wealthier buyers. That can increase supply in a technical sense while failing the affordability test. More square footage does not help if it simply creates a more expensive product for a smaller group of buyers. In some neighborhoods, the boomer exit could accelerate gentrification. A longtime owner passes away, heirs sell, a developer renovates, the price resets, taxes rise nearby, and the next family needs a much higher income to enter. In other neighborhoods, it could stabilize blocks that need investment. Vacant or neglected homes can become occupied again. New families can arrive. Schools, local shops, and community life can gain energy. The difference will come down to who buys, what they do with the property, and whether local policy protects residents while still allowing renewal. Renters should pay close attention. More homes for sale does not automatically mean lower rent. If many inherited homes become rentals, supply could help renters. But if investors buy them and set rents to maximize returns, the relief may be limited. Small landlords are not all the same. Some keep rents stable and maintain relationships. Others price aggressively. Large operators may bring professional management, but they also bring revenue targets and pricing systems that can feel impersonal. The renter experience may depend on whether the next ownership era is family-based, local investor-based, or institutionally managed. Each version creates a different neighborhood feel. Corporate ownership gets a lot of attention, sometimes more than its actual national share. But in certain neighborhoods, even a modest concentration can matter. Buyers feel it when they keep losing starter homes to stronger bids. One block can feel normal until enough houses quietly change from owner-occupied homes into yield-seeking assets. The real problem is not just who owns the rental. It is whether regular families can buy any home before it becomes another income-producing asset. That is the line younger buyers fear crossing. Once too many starter homes become rentals, the ladder gets shorter. Renting may be necessary, but ownership is still how many middle-class families build wealth over time. The boomer transition could either reopen that ladder or pull it higher. It depends on estate decisions, investor demand, mortgage conditions, repair financing, and whether enough new homes are built alongside the turnover. Now let us address the crash fantasy. Some people hope that when boomers pass away, prices will finally collapse and young buyers will get revenge on the market. That feeling is understandable. Years of bidding wars, rent hikes, rejection, and smug advice can make people want the market to break. But hope is not analysis. A national collapse would likely require more than boomer homes entering the market. It would require a severe demand shock, major unemployment, forced selling, credit stress, or enough supply to overwhelm buyers across many regions at once. Price drops without job losses can happen, but they are usually local, gradual, and tied to payment pressure rather than one dramatic national event. Most older owners are not highly leveraged in the same way a speculative buyer might be. Many have equity. Many are not forced to sell tomorrow. That reduces the chance of a sudden nationwide fire sale. But local corrections are very possible. If a market has lots of aging owners, weak job growth, expensive insurance, and too many similar homes, prices can soften meaningfully. That kind of correction may not make national headlines. But for buyers in that city, it could be the difference between impossible and possible. The more likely future is not one crash, it is a sorting. Desirable places remain expensive. Risky or stagnant places become more negotiable. Outdated homes need discounts. Move-in ready homes still command premiums. That creates a strange opportunity for buyers who can be flexible. The best deal may not be the perfect house in the hottest zip code. It may be the solid older home that needs patience, creativity, and a realistic repair plan. Flexibility is not glamorous, but in a tight market it can be more valuable than waiting for the perfect listing. But buyers must be careful. Cheap can be expensive if the roof fails, the insurance quote shocks you, the sewer line breaks, or the commute drains your life. This is where younger buyers need a different mindset. Do not just ask what the house costs. Ask what the house will demand from you after closing. Ask how old the roof is. Ask about electrical service. Ask about plumbing. Ask about drainage. Ask about insurance history. Ask about property taxes after reassessment. Ask what it costs to heat and cool the place. A good inspection may feel expensive before closing, but ignorance can cost far more after the keys are yours. These questions will matter more as older housing stock turns over. The future buyer is not only buying a home, they may be buying decades of deferred maintenance. For sellers and heirs, the lesson is different. Price the home in the market that exists, not the market you wish still existed. Clean documentation, realistic repairs, and honest pricing can create better outcomes than stubborn optimism. A well-prepared estate sale can help everyone. The family gets clarity. The buyer gets confidence. The neighborhood avoids a property sitting vacant for too long. Vacancy is an underrated issue. An empty house can deteriorate quickly. Moisture, pests, break-ins, frozen pipes, code problems, and insurance complications can turn a valuable asset into a stressful liability. If many older homes sit empty during estate disputes, that does not help supply. A house is only useful inventory when someone can actually buy it, finance it, insure it, and live in it. The legal side will matter too. Clear titles, wills, trusts, probate timelines, and family agreements can decide whether homes move smoothly or get stuck. This is the part people rarely discuss because it is uncomfortable. The real estate market after boomers is also a paperwork market. The families with organized plans may transfer assets cleanly. The families without plans may lose time and money. That means the future housing market is being shaped right now at dining tables, in law offices, in family conversations, and in decisions older owners postpone because the topic feels too heavy. Now zoom out. The boomer generation is not one block. It includes wealthy owners, modest owners, renters, people with pensions, people with debt, widows, caregivers, veterans, immigrants, and families with very different histories. So blaming boomers as a group is lazy, but ignoring generational timing is also lazy. They entered ownership in a different era, and many benefited from price growth that younger buyers are now forced to chase. The result is resentment. Younger people hear that they should budget better while rent takes the first bite, groceries take the next, insurance rises, childcare rises, and the house down the street costs more than a normal salary can support. The pain is not just envy. It is the feeling that the ladder moved higher while the advice stayed the same. Older people hear that they are hoarding homes when many are simply afraid to move, afraid of care costs, or attached to the communities they spent decades building. Both sides are reacting to a system that turned shelter into a wealth machine and then acted shocked when access became political. This is why the boomer exit matters. It may be the biggest housing transfer many Americans ever witness. But whether it becomes relief, inequality, or just more churn depends on choices. That is why the next chapter should be judged not by how many homes sell, but by who can actually buy them. Choice 1 is supply. Build more of the homes people actually need. Smaller homes, townhomes, accessible units, apartments, condos with sane fees, and family-sized rentals near jobs and services. Choice 2 is financing. Help ordinary buyers purchase and repair older homes without forcing them into dangerous debt. A house that needs work should not automatically become investor-only inventory. Choice 3 is aging support. If older owners have better options, they can move by choice instead of crisis. More accessible housing, better home care, and realistic downsizing options can free inventory humanely. Choice 4 is estate planning. Families that talk early can reduce conflict later. That does not make loss easy, but it can keep a house from becoming a legal and financial mess. Choice 5 is protecting first-time buyers. That could mean local programs, limits on certain bulk purchases, stronger disclosure, fair lending, and policies that treat starter homes as community infrastructure, not just assets. If the goal is real access, the rules must favor households trying to live in homes, not just capital trying to harvest them. None of these choices is magic. But without them, the boomer transition may simply move homes from one set of asset holders to another. For viewers hoping this means homes will finally be cheap, the honest answer is maybe in some places, but not everywhere and not automatically. For viewers who own homes, the honest answer is that the next generation of buyers may be more selective than you expect. They are not just buying nostalgia, they are buying payments, repairs, and risk. For renters, the honest answer is that more turnover could help, but only if listings become reachable ownership opportunities or genuinely add rental supply. For investors, the honest answer is that aging housing stock may create opportunity, but political pressure will rise if regular families feel permanently locked out. For local leaders, the honest answer is that time is running out. Demographics may hand communities a chance to reset housing patterns, but bad rules can waste that chance. The most important point is this: the market after boomers will not be empty. It will be crowded with heirs, buyers, lenders, landlords, builders, cities, insurers, and families trying to turn grief, equity, and shelter into decisions. It will be a test of whether communities can handle turnover without turning every transition into a price reset. Some neighborhoods will get younger, some will get more expensive, some will get more rental-heavy, some will see prices soften, some will barely change because demand is too strong. The homes that hit the market will not all be bargains. Some will be beautiful and expensive. Some will be tired and negotiable. Some will need so much work that the price tag tells only half the truth. The winners will be people who understand the whole cost, not just the headline price. They will understand rates, taxes, insurance, repairs, location, and timing. The losers may be people who wait for a fantasy crash, ignore local data, or assume every inherited home will become a bargain. That does not mean young buyers should rush blindly. It means they should prepare. Cash reserves matter. Inspection knowledge matters. Credit matters. Local market patience matters. Knowing which compromises are acceptable matters. The smarter move is to watch local inventory, days on market, insurance costs, and estate sale patterns instead of chasing one national headline. It also means families should stop treating housing conversations as taboo. A house is emotional, but it is also an asset, a responsibility, and sometimes the only bridge between generations. When all the boomers are gone, America will not simply have more houses. It will have a clearer view of what the housing market has become. We will see whether homes are still a path into the middle class, or whether they have become trophies passed among people with existing capital. We will see whether communities welcome new housing or keep protecting scarcity while complaining about prices. We will see whether inherited homes become starter homes, rentals, luxury rebuilds, or vacant problems. And we will see whether younger generations inherit opportunity or just higher asking prices in older walls. The answer is not written yet. Demographics are powerful, but policy, lending, construction, family choices, and local culture will decide the final shape. So what happens to the real estate market when all the boomers are gone? More homes will move, some prices will soften, some markets will stay expensive. Inequality may widen. Opportunity may appear, but only for buyers prepared to recognize it. The real story is not that one generation disappears and another finally wins. The real story is that America is about to test whether housing can become shelter again, or whether every empty house simply becomes the next financial product. If this video helped you see the housing market differently, like the video, share it with someone watching this market closely, and comment with this question: do you think inherited boomer homes will help first-time buyers, or will investors and wealthier heirs win most of them?